US markets bounce after Congress passes Donald Trump's big tax cut bill. Just. New Zealand's government smooths out its bond issuance. Japanese business confidence falls amid trade tensions. Singapore warns of a technical recession. And low Malaysian inflation could support a mid-year rate cut. That's coming up in our 5 Things in 5 Minutes on Friday, May the 23rd. And then, in our deep dive interview, ANZ senior economist Miles Workman analyses the New Zealand government's budget delivered yesterday and says it should only have a limited impact on the Reserve Bank of New Zealand's rate cut thinking, if any.
If the Reserve Bank look at these data, I think overall we are still talking a more contractionary set of fiscals than presented at the half-year update, but it's teeny tiny.
But first, in 5 and 5 with ANZ, US stocks have bounced about 0.5% by 4 a.m. Sydney-Melbourne time. And the US 10-year Treasury bond has rallied 5 basis points lower from its close yesterday to be 4.55%. That's on relief. Congress has passed Donald Trump's bill of tax cuts and Medicare spending cuts. The 30-year yield, though, is still stuck over 5%. But ANZ head of G3 Economics Brian Martin says there's still plenty of water left to go under America's budget bridge, which bond markets have revolted at in recent days.
The bond market rallied following news that the House of Representatives had managed to pass its leg of the One Big Beautiful Bill, including President Trump's flagship tax cuts. That flagship tax cut really is just an extension of the tax cuts that he put in place in 2017. The bill will now go to the Senate, where it will be actively debated. Indeed, there could well be amendments, given considerable lobby of fiscal hawks in the Senate. They're not due to vote on the bill until August, so there's going to be a lot of discussion around this in coming weeks and months.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was up 0.5%. The Aussie was down 0.4% at 64.14 US cents, and the Kiwi was down 0.6% at 59.02 US cents. Gold was down too, 0.5% at $3,297 an ounce, and West Texas oil futures were down 0.9% at $61.07 US a barrel. Number 2. New Zealand's government delivered an annual budget with a wafer-thin surplus continuing to be forecast in the 28-29 year, and net debt peaking at a similar level to forecasts in December. ANZ senior economist Miles Workman says all up, there wasn't that much change to bond issuance projections from December.
There was an increase there of $4 billion over the entire forecast there, which is $2 billion more than we expected. But the year to June 2026 and the year after to June 2027, both of those years actually saw the bond program downgraded by $2 billion. So it's a bit of a mixed picture where the overall bond program has been increased, but it's right at the tail end. It's the 28 fiscal year, the 29 fiscal year, whereas in the near term, the market can get some relief at least by the fact that that big wall of bonds that was coming at them is now looking just a little bit smaller than it was previously.
And we'll have more from Miles in today's deep dive. Number 3. In Japan, a fall in the composite PMI to a contractionary 49.8 was led by the services sector in April. ANZ FX analyst Felix Ryan says the report's business confidence reading was its second lowest since 2020.
And that weakness does come from concerns around the uncertainty of a trade policy and foreign demand, which is understandable in the current environment. That's really been the biggest drag there in activity on Japan for both manufacturers and services, it appears in the PMI data. Price pressures, they still do remain firm and do point to some increasing inflationary pressures there in Japan and the services side of things. But we did see a little bit of easing in some of those price gauges.
Number 4. Singapore's final estimate for first quarter GDP was revised up slightly from a negative 0.8% to a negative 0.6% yesterday because of firmer services activity. That didn't stop a warning, though, from the Ministry for Trade and Industry of further negative growth in the second quarter, triggering a technical recession. ANZ head of Asia Research, Koon Goh, says that's not likely.
We believe that at this stage, the risk of a technical recession is quite low, thanks to the current 90-day pause in the reciprocal tariffs. We are seeing export activity still quite strong in the month of April, and with front-loading activity into the US, we think exports will remain firm for the rest of this quarter. That should see Singapore's Q2 GDP growth reverting back into positive territory.
Number 5. Inflation in Malaysia remains steady at 1.4% in April from a year ago. ANZ economist Arindam Chakraborty says the 4-year low in price growth could support Bank Negara Malaysia to cut rates from their current 3%.
Overall, inflation is expected to remain manageable this year, and we think the persistently low inflation will also allow PNM to lower the policy rate by 25 basis points in Q3 2025.
Arundam Chakraborty there. Now, on today's deep dive interview, ANZ senior economist Miles Workman spoke to my colleague Alex Tarrant about the ins and outs of the New Zealand government's budget, starting with the government's favoured fiscal indicators.
When it comes to the Obergau X, which is the new fiscal strategy target measure for the government, there is a surplus forecast for the year to June 2029, but it's only $200 million. It's wafer thin. That's a downgrade from about $1.9 billion at the half-year update. So stepping back, the operating balance outlook is looking a bit softer, but there is at least still a forecast surplus right at the end of the forecast horizon there. In terms of the net core crown debt profile, positive revisions to GDP over history have complemented the debt ratio over the forecast horizon. So net debt as a share of GDP is forecast to peak at 46% versus 46.5% at the half-year update. So that's happening in 2027-28 fiscal year, whereas previously it was 1 year earlier than that.
Now, ahead of this budget, you were mentioning how discretionary spending would have to be cut in order to allow for higher non-discretionary expenses. Walk us through what the Finance Minister announced in terms of spending announcements and also that tax take forecast from the Treasury.
Yeah, so in terms of the overall operating package for the budget, we knew that the government was going to be working with a very small number, just an operating allowance of $1.3 billion, and that's to fund all of its new spending and revenue initiatives. So not a lot of money to work with, but they were able to find $5.4 billion in reprioritizations from within existing baselines, and that really ended up funding the lion's share of the budget package.
Now, the New Zealand Treasury has this indicator called the fiscal impulse, which people generally tie to whether the budget is going to be putting monetary policy or not. What did we see in terms of the fiscal impulse in this year's budget, and how might that be approached by the Reserve Bank?
And essentially what we saw with the fiscal impulse is a bit of a rephasing of the impulse from the last fiscal year into the next fiscal year. So versus the half-year update, I just don't think this is actually that much of a game changer, because this type of rephasing from a less expansionary impulse in the current fiscal year to a more expansionary impulse in the next fiscal year, that kind of wave effect, it pretty much happens every budget or every year because spending delays get pushed out into the next forecast year. So I think the best way to gauge the fiscal impulse is to actually take an average over the forecast horizon. And when you do that and you compare that to the half-year update, we're looking at a small contractionary impulse on balance, negative 0.5% of GDP. At the half-year update, that average was negative 0.6% of GDP. So I think if the Reserve Bank look at these data, I think overall we are still talking a more contractionary set of fiscals than presented at the half-year update, but it's teeny tiny. So the drop in the operating allowance, it's about 0.25% of annual GDP, meaning a rough rule of thumb would say it's only worth a handful of basis points on the OCR, so maybe 5 to 10 basis points. Certainly not enough to move the dial if the Reserve Bank were cutting in 25 basis point increments.
The Treasury made a bit of a point about the global uncertainty that it was conducting its forecasts through. How does that feed through to the risks for the budget?
Yeah, so the Treasury downgraded their economic outlook for growth over the next couple of years. Not a dissimilar profile to our own forecasts, but I think the key thing to note here is the outlook, because of this global confidence and trade shock, it is extremely uncertain, and the Treasury is certainly keen to outline the degree of uncertainty around their forecast. And I think netting it all out, the message from the Treasury is that they are still seeing risks to their forecasts as skewed to the downside, suggesting that this might not be the last economic and fiscal update where the tax outlook is downgraded.
Miles Workman there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 23rd. Catch you next week with more on the global markets approach to fast-rising US government bond issuance. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.